My name is Serge Berger. Very excited to be with you guys today. Let me just take up one more thing here. There's a lot of windows that open here all of a sudden on my screen. Not used to too many screens. Okay. All right, folks. My name is Serge Berger. I'm the founder of thestudytrader.com. I think you made a great choice to attend this webinar today. What I do is I help traders and active investors reach a level of consistent profitability that they never thought possible. Did you know that the reason why most traders are not making money is because they actually overcomplicate things? And that's right. Most traders, in my opinion, make things much too complicated. So today, what I'm going to show you is a highly profitable three-pronged trading approach that has not only made me a ton of money over the years, but has also already allowed hundreds of traders just like you to live a life of financial freedom by reaching consistent profitability. How would you say, like to be able to get up in the morning and not care which direction the market is heading because you have a simple but a repeatable and most importantly a trustworthy process that consistently keeps you on the right side of the market. Furthermore, how would you like to be able to do this from, let's say, your beachside hotel room in Hawaii or your slopeside hotel rooms in the Alps? Well, you know, that might sound a little bit silly, but it's actually a very realistic lifestyle to have if you learn to follow this straightforward three-pronged trading approach that I'm going to show you guys today. Well, financial freedom is what many traders aspire to, and my three-pronged trading approach has allowed me to live a wonderful lifestyle where I spend part of the year in Switzerland, where I am right now, and part of the year in Florida. Success as a trader really is not that difficult, and with the approach that I'm going to show you guys today, I know that everyone can do this. All right, so before we get started, just a quick word about myself so you guys kind of have a little bit of an idea of where I'm coming from. I was very fortunate throughout my career to work both on the sell end and the buy side, so I've kind of been able to work at places like JP Morgan and really see how some of the best traders and investors make money, but also I've seen a lot of different asset classes, from fixed income, equities, and derivatives, and now I'm very fortunate to be able to pass this knowledge on to my direct clients and subscribers and students, and of course the broad audience such as yourself. This is a very good crowd here. I can see a lot of good comments already, so I'm ready. I'm looking forward to having some fun with this presentation for you guys. So I'm all about keeping things simple, as I alluded to before in the introduction. I think trading does not really have to be that complicated. Most traders and investors overcomplicate things. They look at too many conflicting data points. I think that's really what it comes down to. And I think a lot of people really need to primarily focus on eliminating the noise. A lot of folks are, in my opinion, focusing too much on the day-to-day stuff. You know, with all the toys and tools we have these days, from you know, from apps to texts to emails to whatever else you got going on, it's just too much. And we need, and if you want to be successful, you got to really eliminate the noise. So the more straightforward the process is that you apply, I believe the easier it is for you to be able to actually stick with it. So the very best professional traders I have met have a very simple but a repeatable process. In fact, many traders at investment banks and hedge funds only focus on like a handful of stocks, but they get really good at those stocks. And in fact, the two very best traders that I have known over the years, they only focus on one or maybe two types of setups, but they get really, really good at those setups. So if the best traders only focus on one or maybe two strategies or a handful of stocks, then why do so many private traders think that they need to become a jack of all trades when the pros don't need to do that? Well, the key to success is to become an absolute expert at one type of setup or maybe a few stocks across the universe of stocks or indices and asset classes if you choose to do so. Okay? So let's continue along that thought. You know, like I said, institutional traders have a simple, repeatable process. So what I'm going to show you guys today is a highly effective, repeatable, three-pronged trading process. And I know everyone can do this approach. And I actually think that by the time we're through this presentation today, It's literally going to have changed the way you look at financial markets. That's a big claim, but I've seen so many people come through with it with a real aha moment that I'm feel comfortable that a great many of you guys will have that same reaction today. Okay, so let me quickly, before we get started, do a real quick exercise for just 1 minute. I believe that most people fit into one of three sort of stages, and you can answer which stage you are in out loud, if you will. It can also be a rhetorical question for you. It doesn't matter if you feel comfortable with it. So if you're in stage number one, you're essentially beginning, you're just reading and studying, you've never actually done a trade. Not a problem to be at that stage. Everyone has to be there at some point. If you're in stage two, you've done this for a couple of years, you're just going through the initial sort of experience and of fear and greed, and that's very much part of trading and investing. If you're in stage three, you've probably done this for more than a couple of years, but you're still not making as much money as you'd like, or you're still losing money maybe, and all those are fine. So just wanted to quickly, I think it's important for us to be able to sort of put into perspective where we are. So in anything in life, whether that's trading or anything in life, it's important to understand kind of where we are so we learn where to get to. Okay, so quickly on the agenda. What I'm going to explain to you guys today is why identifying investor mood or emotions is critical to success as a trader and investor. And I'm going to show you how to consistently find the highest probability points where to buy any given stock, index, commodity, or currency for that matter. I'm then going to tie all this together to give you the blueprint to this amazing three-pronged trading and active investing approach. So as a bonus, I will also reveal my absolute favorite option strategy that you guys can start implementing right away to generate monthly income. So I hope you guys are excited. Let's do this. Okay, so we're going to talk about candlesticks here for a minute. And I strongly believe that there are way too many candlestick patterns out there to learn them all. I don't know how many of you guys have picked up a book on this, but there's this common notion out there that you have to learn all these different crazy candlestick patterns, and it's just too much. The reality is there's only actually a few that consistently show up, and only a few that are actually consistently profitable. Okay, so you want to use the most profitable ones. Shocking, right? So focus on the ones that work. You can really simplify these things. So let me just give you a real quick example, kind of go through the basics here. If you've seen that, if you're familiar with candlesticks, this will be a good refresher, and then we'll get into the juicier stuff. And if you're not familiar, this will certainly be a good primer for you. Well, in candlesticks, like with any price action, we can have an open, a close of the candlestick. We can have a high and a low. Now we're going to assume that most of these candlesticks today, for simplicity and for today's presentation, they're going to be 1 day bars, like a 1 day. It could be a 5-minute bar, it could be a 1-minute bar, it could be a weekly bar, it could be a monthly bar, whatever you want. But in this case, let's say this was a down day. Okay, so we had an open here, we had a lower close, but an intraday range that extended beyond the open to close range. Well, then we can also have an up day, right, which is the open was here, then we had a higher close, but again, an intraday range that extended beyond the open to close range. Okay. Now, the most important thing for me for these candlesticks and this high, low, open to close range is the close. In this case, the daily close of this candle. Where does that day, in this case, or again, it could be a 5-minute bar, for example, where does that close in relationship to its open, to its high, and its intraday low? Okay, so let's build on this concept. The reality is that about 60%, this is the official statistics, I think it's like government statistics or something very official that I read a long time ago from a couple of research reports. About 60% of us have an easier time learning stuff by seeing a series of pictures. I actually think it's more. I've done empirical research myself, and I think it's more like 70 or 80%, to be honest with you. So most of us have an easier time learning stuff by seeing a series of pictures. Makes sense, right? It's just easier than if you were just be, given a sheet of code or in a spreadsheet. It's just easier. So what are the benefits of the candle? Well, candlesticks are vastly superior to, say, line charts, for example, and even normal type of price action. So for one, they're more visual than bar or line charts. That's number one. They give you a clear visual representation of what's happening on the chart. But the way I look at it, and this is the real key, and this is going to be something that is quite different from what you hear from a lot of places. The way I look at it is that, yes, candlesticks, of course, display price action that's taken place on a chart, in a stock, in a commodity, whatever. But it's also giving us investor footprints and showing us investor psychology. In other words, investor emotions. Okay? So by looking at the price action through candlesticks, we can detect investor sentiment and emotions, and also investor footprints. It's another way of looking at it. Okay, but I'm really focusing on using the keywords investor sentiment and investor emotions. Okay? So let's continue along that thought. The other thing about candlesticks is that they just work. So the formations are very easy to spot once you've trained your eyes a little bit. So it's all about decision making without emotions. You have very, very defined risk and very clear stops. So I chose a picture of this person on this cliff because he or she has some very defined risk, right? You can see this person's risk goes from like 0 to 100 in like one step at this point. And it very much resembles the way I look at trading and investing with candlesticks, because if you use candlesticks the right way and you look at the points where we're interested in buying or selling that I'm going to show you guys today, you will know exactly where you're going to be proven wrong. So it's all about decision making without emotions, having very defined risk. And let's be honest, if you set a stop on a chart, you may adhere to it, you may not. But if you have a visual representation of what's going to happen, of where that stop really needs to be, otherwise the market's going to fall off a cliff, then that becomes much easier for you psychologically to exit that trade at a predetermined stop or at a profit target. Okay, so let me continue along this thought and just give you some types of candles here that we're really talking about. And then we're going to go into some juicy examples. So we're going to look at something called a hammer candle. That's these creatures here. Now, these are more or less all the same things. It doesn't really matter which one we're going to look at. Let's look at number one. Okay, this price action is what we're talking about. Let's assume this was a stock. Again, it could be anything, it could be commodity, it could be whatever. And let's assume we had a downward sloping price action. In other words, this stock had been falling for maybe the past few weeks, the past few days, maybe it's been a few months. It doesn't matter. Let's say it was the past few weeks. So the stock was trending lower, and ultimately on this day, it came in and opened here. This is where the stock opened that day. Well, something happened intraday, and the stock sold off, and for whatever reason, it rallied all the way back and closed actually marginally above the day's open. And it doesn't matter if it closed marginally below today's open or near today's open or above it. It's more or less the same price action. What I'm trying to tell you here is there's two ways of looking at this. Number one is what I call the CNBC way, and this is not to make fun of CNBC. I'm just telling you that's the kind of stuff you hear in CNBC. It's what we call, we're off the lows, Joe, back to you. In other words, you're looking at it and you're saying, okay, we're off the lows, and there's no emotion attached to that statement, right? But what actually happened, and this is the way I think one needs to look at this stuff, is to understand what happened to investor emotions. Okay? The market fell lower. On this day, the bears, after having been in control for multiple weeks, let's say, tried to push the stock lower one more time. Well, they managed to do so for a bit, but by day's end, the stock had rallied all the way back towards the day's opening level. So what really happened through the lens of investor psychology and emotions is that down here, the bears who had been in control for multiple weeks had basically lost control of the game. For this time period, they had lost control. They had reached maximum bearishness. Okay, all else being equal, that's what happened. The fact that they could no longer keep the market lower has basically given the ball to the bulls. Okay, so let's continue along this thought, and we'll do a lot of Q&A later, so because I'm sure there's going to be a lot of questions on this stuff, because this is really good stuff. Let's look at a bearish example. So this is what we call an engulfing candle, and again, the name really doesn't matter, but I'll show you what I'm talking about. Let's assume, just like before in the example we had a downtrend, let's assume this was a multi-week uptrend in this given stock. Well, the stock rallied higher for a few weeks and ultimately became into this day. Stock gapped higher on that day after having already rallied for multiple weeks. It gapped higher, but something happened intraday and the bulls completely lost control of the ball, completely reversed lower, fully engulfing, which is why it's called an engulfing candle, the previous day or previous day's price action, and closing near the day's low. Okay? So again, we can look at this in two ways. We can look at this through the lens of what I call the CNBC way, which is just to simply say, we're off the highs, Joe, back to you. And again, that is true, but there's no emotion attached to that statement. What actually happened is that the bulls, after having been in control for multiple weeks, came into this day, tried to rally the stock one more time, completely and miserably failed, and gave it all back. The bulls had reached maximum bullishness. There were no more buyers up here for this time frame. So by looking at the market this way, you know that this is a pretty good spot to maybe start turning a little bit bearish in this example. Okay, so let's continue along with these examples, and you guys will see more and more how this starts making more sense. Okay, but the point we're trying to make that when we see this, in this case, this bearish reversal, we're looking at the price action, but what it's really telling is that the bulls got exhausted, and if you can pinpoint where the bulls get exhausted and where the bears get exhausted, you have a really good spot to lean against for trades, or in a medium term, short term, longer term trades. Okay, so let's continue along with this. I'm going to skip a couple of slides here just in the interest of time so we can get to the juicy stuff. So let's look at the first chart example. And what I'm going to go through here, we're going to go through a couple of bullet points, and then we're going to look at this chart here much more close up, like in a bigger format. We're going to do this for the next few charts. Okay. So what we're going to look at here is the S&P 500. What we're going to look at here is a waterfall sell-off, which was ultimately followed by exhaustion selling, a strong bullish reversal, and bullish continuation buying. So let's look at the example. This is the S&P 500, and actually this was back in, I believe, October 2014. The market had its first 10 or so % correction in what ended up being a series of corrections over the past. Ever since then, we've had a number of these, I think 3 or so. So let's look at what happened. You can see that the S&P 500 in this case basically trickled lower for a few weeks. Well, at some point in middle part of October, you can see that the bears tried their very best to push this market lower one more time. I mean, they really tried. Well, they could no longer keep that market down. So we can look at this again through the lens of price action. Look at the lens of price action. What happened was that basically, we're off the lows, and that's that. You look at it through the lens of investor psychology, and you realize that this market has been beaten down for multiple weeks, and the bears, now probably getting somewhat exhausted, tried to push this market lower one more time, tried to find more sellers. There were no more sellers. They pushed the market higher twice, 2 days in a row, back to the upper end of the daily trading range. On day 3, we had something called follow-through buying, and the bears ran. They got very scared, and that is when the rally started to take place. So again, we're looking at the maximum point of bullishness or bearishness where we can start taking the other side of investor emotions. Let's look at another example. This is what we call the BKX Bank Index, or the KBW Bank Index. And by the way, if you're not watching this, the ticker symbol is BKX. This index is really, really important to watch. Make sure you watch what the banks do. Always, always, always. It's a bit of a side note. So what we're going to look at here, once we blow up the chart, we're going to look at a bottoming process taking place, which was followed by exhaustion selling, ultimately a strong bullish reversal, and then bullish continuation buying. So let's look at the chart. Again, this is the BKX, and this was actually just 1 year ago, or but just about a year, maybe a week ago. And if you remember in August 2015, if you were involved in the markets at the time, we had a strong sell-off, right? Markets surprised a lot of people, and we sold off. Well, the market then went sideways, but then on this day, which I guess was one of the first few trading days of October last year, the bears tried their very best to push this market lower one more time. You can see that after an already, in this case, multi-month downtrend, they tried their very best to push this market lower. Well, guess what? The bears failed so badly that by day's end, the market rallied all the way back, and the very next day, the market gapped higher, and pretty much it was off to the races from there. So what we're looking at here is, again, is trying to find where the maximum point of bearishness or the maximum point of pessimism gets reached. And if we can pinpoint these spots by visually obvious candlesticks, you can get a tremendous edge over the rest of the market participants, because you're not trying to make things. You can get a tremendous edge over the rest of the market participants because you're not trying to make things too complicated. You're simply looking at what the investor sentiment is telling you through a lens of price action. Okay, so let's continue along this side. Let's look at a bearish example. This is the chart that we look at here of the Spider Trust, or the GLD, or gold. What we're going to look at here is a topping process, which is followed by exhaustion, selling a strong bearish reversal, and ultimately follow through selling. Let's look at it. This is gold, the GLD, and you can see we had a multi-month rally. Nice multi-month rally, and the stock, or the ETF in this case, started getting quite toppy, and there was actually already a candlestick reversal here, but I think this one's not obvious enough. Look what happened here. So after an already decent run up over the past few months, you can see that the market tried its very best to push higher one more time. And what happened through the lens of price action, if you were looking at it that way, is that the market reversed lower and closed at the lows or off the highs. Again, there is no emotion attached to that. The way I look at this and the way I think makes such a huge difference in the way you manage to risk. You can risk manage your trades over time and really truly gain wealth in the markets is by understanding this through the lens of price action. What really happened is that the bulls tried very hard to push this gold ETF higher one more time on this day. They miserably failed, completely reversed lower, so much so that it completely engulfed the previous 4 or 5 trading days. The very next day, we had a follow-through selling day, and it was off to the races lower. Now again, it's the price action that's showing us investor psychology that is extremely important to understand. Okay, so the failed rally is telling us that the bulls tried their very best to push this market higher, but they failed to do so. There were no more buyers. Okay, so I'm hoping this is starting to sink in. Let's continue with the examples. We'll look at one more here. This is Hewlett-Packard. So what we're looking at here is a downward sloping channel, which is not so important. And we saw a bullish hammer candle and ultimately a bullish reversal. Let me just show you the chart. It's a little bit easier to just show you the chart. So what we had here is Hewlett-Packard basically dropping lower, started moving into this weird, unusual trading range, which is somewhat irrelevant to this. But look what happened here. You can see that the chart of the price action of Hewlett-Packard tried its very best to break lower one more time here, and it closed off the day's lows, right? But the bears really tried to push this market lower after having it been successful for what, about a month and a half or so. So the bears really tried to push it lower, failed to do so. The very next day, we saw a huge follow-through buying day, and it was off to the races. So again, we're looking at this through a lens of investor psychology. The bears could simply no longer keep the market down. They ran out of steam. Maximum bearishness was reached, and when that point takes place, the path of least resistance, all else being equal, is to the upside. Okay, so let's look at the 3 steps to the trade. And you guys can write this down. You can take a picture of this on your phone, on your tablet, or whatever you want to do. Okay, so a lot of people think you can just look at a chart and do your trade and that's that. I think it's actually much more than that. It's very straightforward, but it's more than that. So let's take a look at the steps of the trade. Number 1, and I think a lot of people forget this, you do have to have some idea of what the broad market structure looks like. And in by this case, what I'm actually defining market structure as is monetary policy, the political environment, and really kind of the level of interest, or the rate of change of interest rates, of which we can not much talk about right now, And of course, the place we are in the economic cycle. So we need to have some sort of understanding of where we are. Like right now, for example, we are very late in a cyclical expansion. Okay, we are at a point where the Fed is trying to somehow raise rates. I'm not quite sure they're going to do it. That's another discussion. But they're trying to be somewhat hawkish, and it's being reflected in things like banking stocks and the bond market. Okay, but that's kind of where we are. Well, number two, if you understand where we are, you start looking for stocks and things that will tend to do well in this environment. Step number three, you go and you start looking for these strong bullish and bearish reversals that I just showed you guys through the lens of investor psychology. And by the way, here's a little bit of a tip, I should say. You can actually reverse engineer this entire process. So let's say you came across some sort of a very strong bullish and bearish reversal, like the ones I showed you guys. Well, you can then make sure that this fits into some of the assets that would tend to do well in the big picture as it is right now. Okay, so let's give you guys some examples. So let's look at the S&P 500 again. This is the same chart, by the way, that I showed you guys before, except I zoomed out. So if we look at this as step number one, step two, and step three, the bullish reversal I showed you guys before was right here. That's October 2014. And step number one, the broad market structure at the time was such that the Fed was still somewhat hawkish. The economy was still at least somewhat expanding. So having known that, you would basically look to buy dips in something like the S&P 500. Step number two, the technicals. Well, guess what? And I'm going to merge step two and three here for simplicity purposes. But that dip, that strong bullish reversal we just looked at before in October 2014, is actually bouncing or occurred right at that major support line that dated back all the way to 2011. Okay, so step one, step two, step three, rinse and repeat. Look at the BKX. That's that banking index I showed you guys before. Well, this was again, like about 1 year ago. And if you remember what, 1 year ago, the Fed started getting all sorts of hawkish again, kind of like they're pretending to right now, at least. And at the time, it was pretty clear that if the Fed was going to be somewhat hawkish, banking stock would probably, at least from a price action perspective, tend to benefit, and they did. So if you were aware of that as you need to be, then step number two would have been to look for banking stock to do something. Well, step number three, that strong bullish reversal I showed you guys, bullish reversal from last October, so about a year ago, that took place at a major multi-year horizontal support area, and there was very strong bounce off that area. Okay, so step one, step two, step three, you rinse and repeat. Let's look at the gold ETF. I'm going to keep this very simple and just show you the technicals, but it fits right into step one, two, step two, step three. If you saw that bearish reversal that I showed you guys before on the smaller chart, on the bigger picture chart, that bearish reversal took place right here at a major multi-year line of technical resistance. Okay, so again, step one, step two, step three. Let's look at Hewlett-Packard. Make this a little bit more complex to kind of show you that there's different layers to different levels of complexity one can take this to if you want to. But step number one, the market structure at the time when I cut this chart, 2013, 14, was still such that the economy was expanding, things were looking good for this kind of stuff, and tech indeed was looking really good. Well, so from a step two perspective, consider a lot of these tech stocks are actually late cyclical. The technical chart would have asked us to basically buy the dips on a stock like Hewlett-Packard, and then you can see in step three we actually had a very strong bullish reversal right at a 50% retracement take place, and it was off to the races. So again, step one, step two, step three. Now, before we continue, I want to take all your questions here in just a minute. I'll promise you before that I was going to give you a bonus options trade idea. In other words, my favorite highest probability options trade that I do. And it has to do with the slope of the line, okay? Now, there's many option strategies out there. I'm sure many of you guys are applying options in your trading and investing. But there's only one that I believe is truly the highest probability options trade. And again, it has to do with the vertical slopes. It works particularly well with cult stocks like an Amazon.com, like a Netflix, like a Tesla. It'll work well in any asset class really, but it works particularly well in those. What we're looking at here is when a stock goes from a steep slope and it takes that slope into vertical overshooting mode, okay, like I think we're seeing in Amazon.com and Nvidia, for example. Those are some names that I'm looking at right now. We have an already steep slope, and that slope goes vertical. Those tend to be really good spots upon a confirmed bearish reversal, such as I just showed you guys, to start going in and selling out of the money call spreads. Okay, so like there's a chart of Nvidia, for example, which you got to respect the trend, but ultimately stocks like these mean revert 20, 30, 40% very quickly, like Amazon.com, for example, did earlier this year. It's just normal. It's not nothing bearish about these stocks. It's just what happens when a stock takes an already steep slope into vertical overshooting mode. Okay. Now what happens is a couple things. When a stock takes an already steep slope into vertical overshooting mode, a couple things happen. Number one, the implied volatility tends to increase, or at least get somewhat elevated. And the reason for that is because market makers and smart money understanding that that move is likely not sustainable at that rate. So once you have a strong confirmed bearish reversal through the lens of investor psychology, like I just showed you guys with candlesticks, you can go in and sell far out of the money call spreads, like 10, 20, sometimes 30% out of the money, and have like a huge probability of making money. Like I think that's a 95% chance of making money kind of trade. Okay, it's when stocks take particularly these cold stocks take a steep slope into a vertical overshooting mode. Make sense? All right. So let's continue and go through a couple things. Quickly a summary, and then I want to go through and take all and any tickers that you guys have that you might want to go through and look at right now for these potential bullish bearish reversals. So candles show investor footprints and emotions. Okay, a lot of people only look at this through the lens of price action. I think one really has to look at this through the lens of investor psychology. We have to have a straightforward and repeatable process because that is the key to consistent profits as a trader and investors. And then finally, my three-pronged trading process. And again, I repeat, this is important because a lot of people only look at the markets, very much just on the charts. You have got to have an understanding of the bigger picture. You don't have to be an economist, and you don't have to read the Wall Street Journal front to back every day. In fact, I would discourage anyone from doing that. But you got to have an understanding of the broader market structure. That's step number one. Step number two, you scan then for these technically sound stocks and commodities, whatever is working in that environment. And then you do your 1, 2, 3 bullish and bearish reversal trickles, such as I just showed you guys. Okay? So let's continue and look at a few examples you guys will look at. All right? So, for example, okay, Nike. So let's see. Let's look at the chart of Nike. And you can see that, for example, Nike had now is looking more and more precarious. But I don't know, let's look at this, for example, here. Let me just make this a little bit smaller. Here we go. So look at this, for example. You can see that I'm just focusing on this. The most important and the most visually obvious candles, all else being equal, for the most part, tend to be the most important ones. Okay, let me show you what I mean. So this is the chart of Nike. You can see that we had a multi-month uptrend here, very nice rally into the end of 2015. The stock then tried its very best to push higher, right? 2 failed attempts. And then on this day, which was December 23rd, 2015, you can see that the stock tried to rally one more time. You really did. But guess what happened? Now we can look at this in two ways. We can look at this through the lens of price action. What would happen to the lens of price action is that the bulls, after a multi-month attempt to rally, tried their very best to push this market higher one more time. They failed to keep it up here, and the market reversed. Well, what really happened is that the bulls got tired. The bulls got very tired, and what happened is that the area of maximum bullishness was reached up here, right? If you can consistently pinpoint the points of maximum bullishness and maximum bearishness through the lens of candlesticks, you are going to make your life so much simpler in trading and investing. Because unlike what most people think, you don't really have to do too much stuff in between here. There's so much times, guys, when you don't have to do anything in any given stock, okay, or commodity or currency, right? So what happened up here is that the bulls got too bullish. There was no more buyers up here, right? Which is represented by the bulls trying to push the market higher one more time, and they just completely lost control of the ball. The very next day, the stock gave his follow through selling, and it was off to the races. Okay. So let's see. Let's look at, for example, what else is there? Facebook. Okay. So let's see. Let's look at this, for example. Let's look at Facebook here. Okay. So you can see that Facebook, this was actually in January, February, yeah, into January this year. And you can see that Facebook essentially had a nice sell-off, and ultimately we came into this day here, and you can see that, you know, after a nice multi-week sell-off, the bears tried their very best to come in here one more time and push the market lower. Well, 2 days later, the market gapped higher and rallied very strongly. So again, through the lens of price action, what happened is that the market just got exhausted, and you know, we closed off the day's lows. But through the lens of investor psychology, what this is telling us is that the bears ran out of steam. There was no more sellers down here, and it's being visually represented to us by the bears not being able to hold the market down. Just like up here, the bulls got too bullish, and you can see that they tried to push this market higher, failed to hold it up, and the next day we had follow through selling. The key to a lot of this, guys, is the follow through buying and the follow through selling, and a lot of people do not focus on that stuff. Okay. So let's look at a couple more examples. Someone wanted to look at, Penny, you were saying you wanted to amplify the candle structure. Can you clarify what that means? So John wants to look at Goldman Sachs. I can't pull up, unfortunately, I can't pull up any currencies on this platform. I don't have the currencies. I'm using e-signal here, and I don't have the currencies signed up for this. But let's look at, for example, here. Look at Goldman Sachs here. Okay. So look what happened. So we had a multi-week sell-off, multi-month sell-off actually in Goldman Sachs, and we get to this point. Now you can see we had the sell-off started to intensify, and ultimately the bears tried to push this market lower one more time after an already steep sell-off. Well, they gapped the market higher 3 days in a row. That tends to be a pretty good point to consider, you know, what happened down here. Well, what happened is that the bears got tired, right? The bears visibly got tired. Let's look at this on a weekly chart, just so you guys can see. Okay, this is now taking it to another little bit of a level. This was actually what we call a bullish engulfing week. Same deal here. You can see what happened here. Look at what happened here. The market had been pushing lower, and ultimately we came into this week. Well, the bears tried their very best to keep this market down, push it below the previous week's lows, but they miserably failed. The market rallied all the way back, almost completely engulfing the previous week, and then very next week we had a bullish confirmation buying week. Okay. So this is what we call high probability bullish and bearish reversals. Now there's a lot of questions here. Let's go through this stuff. I want to do one more thing. Albert Einstein once said the definition of insanity is repeating the same behaviors and expecting a different outcome. And when it comes to trading, it's all about having a plan. And you know, a plan really starts with having some knowledge. And if knowledge is what you seek, I would like to offer you guys my ultimate candlestick bootcamp, which I usually sell for $247. And what it is an 11-part recorded video series. Okay, it's an 11-part recorded video series, and I'm going to explain to you in great detail the institutional 3-pronged trading approach. It's all about low stress, high probability swing trading. Okay, you're going to learn how to nail the reversals by correctly reading investor sentiment and emotions using candles and more. Okay, so this is an 11-part recorded video series, and we'll go back to you guys' question in just 1 minute. It's an 11-part recorded video series and includes the bonus 30-page course guide. But I'm going to offer it to you guys today for just 97 bucks. One-time payment, just 97 bucks. So what you need to do is you need to go to thestudytrader.com/1. I believe I can type it in here. /1. And you can get that there. It's just a one-time payment of just 97 bucks. That's it. It's usually $247. It's an 11-part recorded video series plus the 30-page course guide. thestudytrader.com/1. The 30-page the course has a 30-day money back guarantee. I do not think this course is for people who are not serious about this business. I think if you are more into for the entertainment, which of course I see a lot of people are kind of into this for the entertainment, I don't think this course is for you. But I do think this course is for people who want to learn how to make their own decisions in trading, for people that really truly want to gain financial independence and understand how markets work. And so it's really for disciplined self-starters who can actually follow a three-pronged rules-based trading approach that instills a repeatable process into their trading so that it doesn't become, because trading really needs to be something that doesn't take a lot of emotions. In fact, if you have emotions in trading, it doesn't work. So this course will teach you how to trade and invest without any emotion. So it's just 97 bucks. It's a one-time payment. There's no other payments or anything. Just 97 bucks, one time for an 11-part recorded video series and a 30-page book. thestudytrader.com/1. Couple more things. There's some testimonials here. I'm going to skip through this. So what you're going to learn in this course is the institutional three-pronged trading approach. I'm going to teach you guys all the variations of the bullish and bearish reversals that are important. There's many ones that are not important. You're going to learn how to use candlesticks to trade in the direction of the trend as well as against it. Okay. You're not going to have to learn against it. Okay. You're not going to have to learn hundreds of candlestick patterns. That's not what I'm about. I don't think that's worth it. You're going to learn my rocket launch and gravity pull setups. These are really high probability trading setups. As probability enhancers, and this is a course in and of itself, really, I'm going to teach you guys multi-time frame analysis in the course, a confluence zones. Confluence zones are very, very important to understand. That's where you have really high probability trades set up to combine multi-time frame analysis and confluence zones. Also, guys, I'm going to show you guys how to really properly play some things like channel breakouts, wedge or flag breakouts, all through the lens of investor psychology using these candles. Trending gaps, lateral breakouts, resistance, support lines, moving averages, momentum oscillators, and even Fibonacci retracements. All these things together combine extremely high probability trades. And if you look at this stuff and learn it through the lens of investor psychology, you can really start becoming profitable and not be nervous about trading and investing. It doesn't work if you're nervous. It has to be done with a repeatable rules-based approach that you can actually trust every single day. Okay, so you can go to thestudytrader.com/1 and just pick it up for 97 bucks. That's it. Okay, you're also going to learn, by the way, where to set your stops. I'm going to teach you a sound risk management strategy, a little bit of the mental aspect of trading, money management. So there's a lot of stuff in this course, guys. So I would highly encourage you to go ahead and take it as you can, just clicking on the link there. Okay, so let's go into some questions here. Now, Ben was asking this. Okay. Ben, you're asking a bit of a question that's a little more complex. I'm not quite sure we have time for that, but I'll give you an idea. So let's just look at a couple of bullish bearish reversals, for example, that have taken place of late here, and I'm going to start including some other stuff in here now so you guys can see how things tend to kind of get together. Okay. So let's just stay with Goldman Sachs, for example, and you guys will see this is what you'll learn in the course. Okay. Let's just focus, for example, on this point here. Okay. Now, what we had take place here is a strong bearish reversal, and that bearish reversal took place at a real confluence area of resistance. Again, this is what you're going to learn in the course, along with many other things about how to use candlesticks through the lens of investment psychology. Well, let's count the confluences that took place here. Well, number one, we had a strong bearish reversal that took place near the 200 and 100-day moving averages. I say near because we had a breakout above there and a quick fake out back below. We had actually had something called an island reversal, okay? And so that's certainly number one. Number two, there was a big area of former price support and resistance that the stock came into. This, you can see resistance, then it became a little support, and then now began resistance. Okay, that's number two. Number three, we have what we call a perfect Fibonacci retracement. A move lower, back up 61.8%, and down it falters back below. Okay, but again, to me, the most important part about all this is what is being able to detect the price action through the lens of investor psychology, looking at these candlesticks. To me, that's by far the most important thing. So it's the confluence of things coming together that's most important. And the price action trumps everything, right? We can look at 1,000 different indicators. If price action doesn't actually confirm what we need to see, it's invalid, right? So what other stocks do you guys want to look at? What other questions do you have? I'd like to see some more stuff to go through. I know there was a lot of questions here before. Let's see here. David wants to look at Alcoa. Are you still around, David? Just want to make sure you guys are asking still or actually around. Well, I'm looking at Alcoa right now, and quite frankly, there was a very strong bearish reversal. So I look at this, and this is now a weekly chart, okay? Okay. Oops, that's the daily chart again. Let's look at the daily chart. So let's look at what happened here. We can apply the same rationale. And again, guys, don't forget to go pick up the course. It's a 11-part recorded video series with the 30-page ebook. It's just $97. That's it, one time. TheStudyTrader.com/1. So let's look at Alcoa. I guess let's just focus on this one right here. So we had a very strong bearish reversal. We can apply the same analysis here. We can apply now the gap down analysis, which is also something you're going to learn in the course. Okay, let's look at a couple things here. Let's focus on 2 points. Number one being this. Number two being this. So here, of course, we had earnings. So I don't trade before earnings. Personally, I think that's a low probability trade. But once you've had a big, meaningful move to the downside, let's just see what happened. Well, the bulls rallied this stock, Alcoa, right into earnings. Well, guess what? After earnings, the stock crashed lower. Well, through the lens of investor psychology, it's telling us that there were no more buyers here, and the fact that the market gapped lower so dramatically tells you that the buyers are anywhere near this stock, nowhere near the stock, and the stock's drop is completely rejecting this price area. No more buyers here. You could have shorted it, or at least sold it at the very least if you were long, right after the earnings release last week. Now, another thing is this area here. Okay, now this is a classic, what I call bullish and bearish reversal. You can see what happened. Very strong rally. Ultimately, the stock came into this point. The bulls ran out of steam. They visibly tried to push the market higher one more time, failed to keep the market up. Very next day, a bearish reversal, and it was off to the races lower. Let's look at this spot down here. Same deal. Sharp sell-off. Market tries to push the bears try to push the market lower one more time. Exhaustion selling, right? Follow through buying the next day, and it was off to the races higher. A lot of people just try to do way too many trades along all these points here, when in actual fact, there's only high probability trades in any given stock or commodity trading, setting up every once in a while. You know, maybe once a month, maybe once a week, maybe once a quarter. You know, that's just how it is. A lot of times the market actually goes sideways. Now there's sideways strategies you can apply, but that's another topic for another day. Now Ben wants to look at CLVS. Kent wants to know how do you trade reversals? That's what the course is for. That's gonna, you know, that's really what the course is trying to teach you. How do you trade these reversals? How do you spot this? How do you get your head around it? What's the risk management? That's what the course is for. I only have, I think, another few minutes here before the webinar is over. I can't give you everything in 1 hour. It's just not enough time. But that's what this is, what it's supposed to be for. Okay, so make sure you guys pick up that course, thestudytrader.com/1. Ben wants to look at CLVS. Oops, let's get this one. CLVS. Okay. Let's see. Right now, personally, I don't see a whole lot here. I don't see anything significant personally from a bullish bearish reversal perspective. I only like to look at stuff when I actually see a visually obvious move, right? Like for example, let's just go back to Facebook for example. Okay. Like when I see this kind of stuff, like watch this. This is the kind of stuff you guys are going to learn in the course because it's all about high probability trades. High probability trades and investing is where it's at. Most trading signals that people get are actually invalid, especially, you know, if they look at the same stock all the time. You have to just be able to focus on the few that actually matter. And then what happens, you'll see your profitability go through the roof and you're going to relax much more. So that's what happens over and over and over again. I see this with all my students. Once they get to that point, they take a course like this and they start to understand it. That's what happens. So look at this point. Let's just quickly go back to the chart of Facebook. This is what we're talking about. So we looked at this quickly before, but since we did it before, might as well quickly look at it again. So what happened here? So we had a strong sell-off. Market comes into the 200-day moving average, which is that red line. Okay. And guess what? The bears tried to push the market lower one more time, failed to keep it down. The stock closed back above the 200-day moving average on that day, gapped higher 2 days lower, and it was off to the races. So here's what you can learn in the course. You can learn about these confluence support and resistance areas. So why was this confluence support? Well, let's look at it. For one, obviously we had the 200-day moving average, which had been as support before. Number two, look at this. We had what used to be resistance became support. Number three, from a retracement perspective, okay, the market had retraced exactly 50% of this entire rally. So it rallied and then it gave back 50%. A strong confluence support area, okay? And then what happens is we had a strong confirmation buying day 2 days later. And that's it, off to the races. So what we're trying to do is looking at these points as the maximum point of bearishness in this case, just like this was the maximum point of bullishness. I promise if you can learn to look at the markets through a lens of investor psychology, then you will start to see your profitability go through the roof, and you're going to become much more calm about your trading and investing because you now have reference points where you can trade against, knowing that if the market in this case were to drop below this point, it would cause some major technical damage through a lens of investor psychology and also, of course, the technicals. Okay. Alice is asking about call spreads on weekly and monthly options. What exactly is your question there? My favorite options trade depends on the type of markets, but personally, I like to sell out of money call and put spreads. Oh, I do only, Alice, I only do monthly options, only monthly options. You can do weekly options. I just don't think the odds are there as much, personally. There may be a trade here and there, but for the most part, I do monthly options. So, okay. What other stocks do you guys want to look at? Let's do a couple more. And again, don't forget the course, guys. Just to repeat quickly, this is my ultimate candlestick bootcamp. I have the wrong name up here. It's the same course. You can learn all about my institutional 3-pronged trading approach. low stress, high probability swing trading. You learn how to nail these reversals by correctly reading investor sentiment and emotions using candles and more. Again, it's just 97 bucks. TheStudyTrader.com/one. Usually I sell it for 247, so you're going to get a really big discount today. It's an 11-part recorded video series, and it includes the 30-page course guide. Okay? So also in the course, let me quickly show you, you are going to, interesting, if this is not, oh, because it's the end of the line, okay. Anyway, let's go through some more examples. Let's look at Netflix. Yeah, that's a good one. So obviously, what happened to Netflix today? Well, a big rally. So this now, this is not so much a bullish or bearish reversal, but I'll tell you, this is something you can learn in the course as well. What to do with a move like this. I will tell you, all else being equal, you probably need to start looking at Netflix again from the long side. Okay, why? Well, and I don't think you have to rush into it right away, but today the stock told us that basically this entire consolidation phase, maybe even stretching as far back as back to August of 2015, it may be over. Okay, that's what this gap up is telling us today. There is a very clear breakout and all sorts of stuff happening here, but again, you learn in the course, thestudytrader.com/one, and make sure you go pick up your course. Then you're welcome, Alice. I hope that was helpful for the options. PRAH. Okay, well, if you look at PRA, let's look at, for example, on a weekly basis. Okay, so what I'm looking at PRA right now, and I see a very strong bearish reversal on a weekly chart. Okay, now I haven't yet seen confirmation selling. I'd like to see that, which again, you learn this in the course. But what I am seeing is a market rallying very strongly. Coming into last week, market tried to push higher, completely reversed lower, fully engulfing the previous 2 to 3 weeks. And this week so far we are consolidating. I would like to see a little bit further weakness, but this is a pretty good spot to look for. This is what happens. Maximum bullishness took place here. Ticker symbol is PRAH. Yeah. Okay. Cool. Would I do a call spread on Netflix today? Potentially, but just give yourself enough time. I mean, again, I can't give you financial advice here, but personally, what I'm going to look at in the next few days is look at Netflix from the long side using call spreads, or maybe out of money puts, short out of money put spreads. But I'm going to give myself at least a couple months, at least December options, probably even January if they exist, and I have to look at the papers at the options chain. Okay. So how about CRM? This is a stock that I'm looking at in the clubhouse with members for the past couple of weeks, and we had a really nice trade last week on this. And in fact, my B2 reversal indicator, which is amazing, gave us a really, really good buy signal in this, and I'll show you another stock in just 1 minute. So look at CRM. Now, the stock is still kind of just doing its thing right now, but you can see what's taking place here. Let's again look at it through the lens of investor psychology. Well, what happened is CRM has been, this is Salesforce.com, has been pushing lower, and ultimately came into this day here, which was last week or 2 weeks ago, I believe, on the back of this Twitter news. Well, the stock gapped lower, gave us what I call actually an island reversal, but think what happened. The market gapped lower. Well, the very next day, the market gapped right back higher. That tells you that there were no more sellers down here. The sellers were gone. The market could no longer keep the stock down here, and it went higher. Okay, let's look at another stocks. I got this trading signal just last Thursday. Okay, ticker symbol called IMAX. This is my B2 reversal indicator. Gave me this. Okay, check this out. IMAX. Market has been in a real nice downtrend. Came into this move here. You're welcome, Michael. I'm glad you're enjoying it. Make sure you pick up the course. You guys will do yourself a huge favor by picking up the course. I promise you. It's really going to show you how to look at the markets through the lens of investor psychology. That's what we need to do, because if we can't look at it that way, you know, it's just much easier to manage the markets by looking at it that way. It gives you visually and psychologically a much better way to flow in and out of trades. So make sure you take the course, guys. It's just, I mean, it's just 97. It's basically giving it away. Again, it's an 11-part recorded video series, and it includes a 30-page ebook that I think is very, very valuable as well. So look what happened here. So this is what my B2 reversal indicator gave me the other day. IMAX, strong downtrend. We came into this week here, or this day. This was last week. This was last, I guess, Wednesday. The following day, or on this day, the market tried to push lower. The bears tried to push the market lower one more time. Well, they failed to keep the market down there. The stock quickly reversed back higher off the lows. The very next day, we had a bullish engulfing day, and then it was off to the races on Friday. Real nice rally day on Friday. But if we would have noticed this, and my B2 reversal indicator, by the way, did that, you'll learn more about that by taking the course as well. We knew that this was a point of maximum bearishness. So we entered the trade here. My price target was hit the next day. Okay. Yeah, the offer's valid. Yep. Absolutely, 97 bucks. Yeah, so Ben, you learn about this in the course. I'll teach you exactly where the confirmation is. It depends on the type of setup. That's why you have to take the course. I can't go through everything. I think pretty much actually I'm over time now. Probably have to stop now. But basically it has to do with the combination of what the exhaustion looks like here from a psychological perspective, and then what the follow through buying day or days were going up. Yes, Stephen, the course is you can do it in your own time. It's not live. You can just take it, peruse. You can take it 100 times. You have access to it forever. It doesn't go away. So people love it. People are. I really tell you, people who look at this, and if you can truly switch your mind into that of looking at the market through the lens of investor psychology, three things happen. Number one, you start to see the market much more clearly. Okay. Number two, you stop over trading. 99% of people, or I don't know if it's 99, maybe it's 98. I don't have done the math, but the vast majority of people overtrade, dramatically overtrade. Okay. Now that doesn't mean you don't have to take all your valid signals, but if you valid signals come like let's just go back to Facebook, for example, just because we had that before. If you valid signals are this kind of thing and this kind of thing, maybe this kind of thing, maybe this kind of thing, you have a trade in any given stock maybe every few weeks, maybe every couple months. But if you follow 10, 20, 30 stocks, maybe some commodities, whatever your market is, there's something to do every single week. So like a lot of my Clubhouse members, for example, last week we showed them IMAX, one hell of a trade, right? Then for example, we did some bearish trades in in Caterpillar, some smaller ones. There's always something happening, but you just have to make sure you focus on the high probability stuff and don't overtrade. And if you look at the market, the lens of investor psychology, again, let me quickly go back. A couple of things happen. Number one, for one, you start seeing the market more clearly. Number two, you stop overtrading. Okay. Number three, you start trading with much less emotions. There should be no emotions involved when you trade. And by the way, look at the weekly chart on IMAX. I'm going to show you one more example. Look at this. Another very strong. Let me show you this in plain white chart. Just want to show you guys this. Or actually, no, yeah, I can show you here. Like, look at this, for example. Okay. This is another one. Beauty of a trade. Strong exhaustion selling, follow through the buying a couple weeks later, and boom, a massive week the next day. Okay. Okay. So that's it, guys. I think I gotta probably stop here, otherwise they're gonna kick me out of this room. But I certainly want to thank all of you. I want to thank Cyber Trading University. very much for allowing me to speak to the great audience. Again, guys, make sure go and take the course. It's just 97 bucks. thestudytrader.com/1. I think you do yourself a great favor by doing that. And wish you all the best of luck. Again, it's an 11-part recorded video series with. Wish you all the best of luck. Again, it's an 11-part recorded video series with a 30-page ebook. So go ahead and take it. You got nothing to lose. Just 97 bucks. Thank you very much, guys. Have a great, wonderful day rest of the day wherever you are. And I hope to be able to see you soon in the course. Take care, guys. And again, thank you so much for listening.